Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
On today's show, we'll be talking about rights offerings with Executive Vice President of Mackie Research in Vancouver, Shayne Nyquvest, President and CEO of MGX Minerals, Jared Lazerson, co-founder and president of Glance Technologies, Penny Green, and president and CEO of Tower One Wireless, Alex Ochoa. Shayne, what are companies doing to finance themselves in today's environment?
Well, in today's environment of, shrinking brokerage firms, we've gone from 50 brokerage firms to 5, although the good news is there's 3 new ones this year, which I'm cheering for. Bank domination has reached record levels of 82%. So companies have been forced to the sidelines, and, fortunately there's been enough forward-thinking people here, like some of the people at the BC Securities Commission who've done a great job in trying to innovate and pick up, some of the slack where it's been left off. They've had the foresight to approve 10-for-1 rollbacks, to be followed by rights issues. Rights issues are the fairest way to treat shareholders. 82% of all financings in Australia are done via rights issues. Rights issues, treat insiders and all shareholders equally. It also took Donald Trump, it's a Trump plug. It took him about 2 weeks used to be U.S. shareholders could not exercise rights. They now can, which opens up the market to a much larger audience and treats them equally as fairly as well. It used to be their rights were sold. Rights trade in the market for a period of 21 days. You can buy them, sell them, exercise them, and they're usually priced aggressively. The key to venture capital is being able to raise enough money to keep these companies going. So you got a better chance of producing better companies, the larger pools of capitals that you can raise. Obviously, the gatekeeper function, needs to be part of it.
Shayne, from a broker's point of view, what are the advantages of warrant financing versus a private placement?
Okay, well, let me try and tackle that twofold. In this day and age, as I've told you, from 50 brokerage firm to 5, there's a lack of analysts, there's a lack of coverage, there's a lack of support. So, in this day and age, and what used to be imprudent maybe a decade or so ago, which was to spend a whole lot of money on IR and getting your story out, it has never been more prudent than it is today. Because if you put out a news release, your audience is so limited by the fact that there's only 5 brokerage firms now. You have to build your own audience. You have to build your own shareholder base. So, and that cost gets incrementally cheaper as you go on. Because once you've created 5,000 shareholders, and you wake up one morning and you don't know who's on the bid and who's on the offer, you're officially a public company. Until then, you're not. So, how does that relate to unplugging the system? Brokered or non-brokered private placements, this mountain of paper that is really just a backdrop for securities overregulation is not the answer. The answer is to price these things in the context of the markets, to be able to raise the maximum amount of money for the companies behind them. They're free trading units. They're not 4-month hold rigged situations that are not tradable for 4 months, and then you got a mountain of stock coming at you. And bottom line, the back office system and the over compliance that we deal with today anyway gets completely bogged down when the frequency of money or the velocity of money increases. So there's no time or effort or compliance wall that you can put up to, try and weed through these things. Who needs less disclosure than an existing client who probably knows more about the stock than the broker who sold it to him and is now selling cars anyway? That is the basis of allowing that these issues can be sent out, subscribed for, and you've got a 5 to 10 day period to disclose what your proceeds are for, and the cost is $20,000. as opposed to $250,000 for a complete prospectus, which is frankly a waste of time and money for the investor who just wants the maximum amount of dollars to go to progressive things like building companies. I'd take that even further. In my opinion, lawyers and accountants should have to take 25% of their fees in stock. I don't find it a conflict of interest. I find it part of the gatekeeper function, and I think it's it keeps them involved in the progressive nature, because time is money and wasting of time is money, and so is timing. Timing is only everything when it comes to the markets.
So, Shayne, how exactly does one exercise a warrant?
So, warrant redemption program, early warrant redemption programs are just as they're described. There is a warrant out there that's not in the money. It's maybe 18 months out, and maybe best to just give you a real-life example of how that benefit works. For example, we did a rights issue on a company called Glance. Glance did a rights issue, and they had warrants that existed, some 50% higher than the current market. They were expiring. The shareholders were given the option to convert those to a free trading unit priced in the context of the market, which for them is a tremendous benefit. Their warrants were going to expire worthless. We decreased the price and gave them a free trading unit and priced it in the context of the market. And those are all treated, your shareholders are all treated equally. And that's what it's all about, is increasing shareholder value by building good companies, being able to raise, larger pools of capital gives you a better chance of creating better companies. So, to be specific, those warrants were 50% above the market. They were repriced into the context of the market. There was a period of time that was given whereby they could sell their warrant and someone else could exercise it, or they could exercise it into a free trading unit. I think we had a 99.9% success rate on that, and you'd either have to be out of town or out of your mind to not exercise them. When I started in the business, I wasn't smart enough to know there was no diamonds in Canada. So now I wake up every morning and there's 15% of the world's supply, $15 billion a year in revenue, and 8,000 jobs. That's what venture capital is all about.
I'm now chatting with Jared Lazerson, President and CEO of MGX Minerals. Jared, why did you choose to do a rights offering instead of a private placement?
Two reasons. The first and foremost was really to offer to our shareholders. We have a tremendous support from our shareholder base, and we wanted to give them first cut at being involved in any new financing, a very democratic process. The other piece is free trading. The rights period is fairly long, the minimum period under which you have to wait until shareholders, rights holders subscribe to the rights. But once the offering is closed, it's just a matter of days before having free trading stock. I'm a long-term investor. I don't really look at a 4-month hold as being significant, but a lot of people don't like having this looming date or overhang of financing, as we usually term it. So this financing overhang basically kicks in right away with the rights offering, but it means you're through it that much quicker. So anybody that needs to rotate stock or sell stock and keep the warrant, or sell the warrant and keep the stock, whatever their investment strategy is, you deal with it in the early phases and not 4 months down the road when you kind of have this looming date that can be a real clip on the stock. So those are the two main reasons.
Jared, how can people find out more about MGX Minerals?
MGX Minerals traded on the CSE under XMG and on the OTCQB under MGXMF, and of course mgxminerals.com.
We're now talking with Penny Green, co-founder and president of Glance Technologies. Penny, you did a rights issue earlier this year. How did that work out?
Hi, Jim. The rights issue went very well. We were approached by Mackie earlier on in the year to see if we wanted to try out a rights issue under the new rules. We had seen the success that MGX Minerals experienced with it, and so we went ahead and did it. It was very successful. We were able to offer all of our existing shareholder base the right to buy a share at a slight discount to market. We ended up selling about 80% of the rights that were offered, and we really got to benefit our shareholders who participated. Later on in the year, we did some additional financings, and eventually, our stock moved up, so we ended up with some very happy shareholders.
Penny, why would you do a rights issue opposed to a private placement?
Well, the beauty of a rights issue, Jim, is that when shareholders exercise their rights, they get a free trading share or a free trading warrant. So typically with a private placement, there's a 4-month hold. And in the public company world, 4 months is a long time. A lot of investors are more reluctant to put their money on hold for 4 months, whereas if they see that a stock is trading well, that has good volume, and they know that they're going to get a share that's immediately they're able to sell it, then they're more likely to put their money in.
Penny, can you tell us about the early warrant incentive program Glance did?
We did the early warrant incentive program on the advice and the guidance of Mackie Research. Mackie Research had worked with the BC Securities Commission to come up with a way that would allow companies to raise money in a more efficient manner. And what we did was we took our existing warrants, which were priced at 33 cents, and we repriced them at 20 cents, which was more at market, for a period of about 45 days. And then we also took another set of warrants which were priced just above market, and we extended them for a month. And then in combination with that, Mackie made some excellent referrals to us in terms of how to increase the awareness of our stock. They put us in touch with some great publicity companies, including yourself. And we've really been putting a lot of time and energy into making sure that the American and Canadian investor public are aware of our stock, that they know we exist and we have a good story to tell. So we've been telling it to whoever would listen. And the great thing has been that a lot of people have bought our stock and our price has moved up significantly.
Penny, how can people find out more about your company?
They can go to one of our websites, either glancepay.com or glance.tech.
I'm now chatting with Alex Ochoa. He's the president and CEO of Tower One Wireless. Alex, what's your experience been with warrant raising of funds?
Well, what we did was the early warrant exercise, which brought in a critical part of cash to the company at a time when it was needed. That was spearheaded by Mackie Research, and what it did was basically facilitate attracting those investors, since there was no need to lock them in for 4 months on typical financings. And I think that's a pretty clever route for all companies that face different stages of their financings to take.
Alex, could you give us a little more information about what Tower One Wireless does?
Absolutely. Tower One Wireless is a telecom infrastructure company. We're more a real estate company than technology, where we build cellular towers across Latin America, currently in Colombia, Argentina, and Mexico, and we lease them out to the mobile operators on 10 to 20-year terms. This business is traditionally one that has been held by the larger companies, which are only 3 publicly traded entities. We're basically the only nano or small cap stock in the space with the same clients in the same countries under the same rental terms. So the entry point into this industry has been relatively impossible. The options today are either buying 3 larger stocks at about $140 a share, or striking $5-10 million checks to the Blackstones and KKRs that invest into the tower space. So having the ability to have the same clients, which are all AAA tenants, and providing an investment alternative for investors into the space, I think is one thing that has created a lot of attention in the space.
Alex, how can people find out more about Tower One Wireless?
I think the easy place to find more information is on our website, www.tower1wireless.com. We're listed on the Canadian Securities Exchange, also over the counter on the OTCQB, and in Frankfurt. So I think we've managed to cover the investor base we have today in these exchanges.
And that wraps up our show for this week. We'd like to thank our guests, Shayne Nyquvest, Jared Lazerson, Penny Green, and Alex Ochoa. I'm Jim Goddard. If you have any questions for the show, you can send them to info@howstreet.com. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.